Okie doke, let's continue on here. So we got through all of that depreciation stuff and our 4 components of depreciation. Our basis, class lives, depreciation, or depreciation periods, conventions, and our methods. And I said that you really don't have a choice with regard to depreciation for tax purposes, but like every tax issue, there are exceptions. So there are a couple of different options with regard to immediately expensing assets. Meaning you take the deduction for the full amount right up front. And one of those expense elections is called the Section 179 deduction. That's how it's referred to. It's referred as, as its code section, Section 179 deduction. This used to be a lot more popular deduction than it currently is. I suspect it will go back to being a popular deduction, and I'll kind of tell you why here in a second when I talk about one of the other deductions that are expensing elections that is available. So the Section 179 expense election allows companies to fully expense assets, so you don't have to depreciate it over time, fully expense those assets in the year that they are placed in service. Under certain circumstances, there are dollar limitations though on how much can be utilized for that Section 179 election. There are also some restrictions with regard to the types of assets that can be used. So first off, it can be new or used assets. It doesn't have to be brand new stuff. It could be something that's used. But it cannot be an item that is used. It has to be personal property. Okay, so no real estate can be immediately expensed. So that's one big limitation. For the most part as well, I shouldn't say for the most part. They kind of changed. It used to be that you could not expense any assets, or you could not use the Section 179 expense election with any assets that were for rental properties. That's not necessarily the case anymore. You can actually expense assets that, components that are attached to rental properties. So like HVAC systems, air conditioning systems, carpeting, that kind of thing. You actually can use the Section 179 expense election. So the dollar limitations, however, and this changes every year, as you can see. So they've got an example here of what it has been in previous years. When I started practicing back in the early 2000s, this deduction limit was $25,000. Now it's $1,160,000. But it is limited to that amount. There's also, we have to look at the total number of personal property assets that were placed in service during the year. So just like we did with that convention, the mid-quarter convention, where if you place more than 40% of your personal property in service during the last quarter of the year, well, now we also have to look at how much personal property we place in service during the year to determine what our limit is on Section 179 expense. The upper limit, the most that we can take, is $1,160,000 of 179 expense. And so essentially what that means is if you place into service, so let's say you have personal property assets placed into service of $800,000 in total during the year, you can choose to write all of those off for the year. So now you're giving up a future deduction. right? Because you're taking it now, currently. But maybe you had a whole lot of income this year and you want to be able to offset that income with this larger expense this year. And maybe you think you're not going to have as much income next year. So that would make sense then to go ahead and take advantage of that full write-off in the current year. Now, if you have personal property, this is well under the $1,160,000. So what happens if we place into service in total more than $1,160,000 of personal property? So let's say we had, we had some equipment, we had some furniture, we had some computers, and we placed into service a whole bunch of stuff. This was $1 million worth of equipment, and the furniture was $200,000, and the computers were $200,000. So in total, we would add all of that up. So $1,400,000 in total of personal property that was placed in service during the year. So that's the first step, is you want a total of all of that personal property. Don't include the real property, any buildings or land or anything like that. Don't include that because you're not going to be able to use the Section 179 expense for that anyway. So this is all just the personal property. Then what we do is we've got this phase out, which starts at $2,890,000 and goes up to $4,050,000. That phase out range represents the total personal property placed in service during the year. Okay, that's not our deduction limitation. Our deduction limitation is this $1,160,000. So we can't take more than the $1,160,000 in deduction, and that starts to be reduced dollar for dollar once we start placing into service more than $2,890,000 of personal property during the year. So what you would do, and you'll see how in this case we're not going to be limited because we're not placing in service more than that $2,890,000. Second step of this, so first step is step 1, total purchases. Total all of your personal property purchases, asset purchases. So that's step 1 here. Step 2 is we're going to subtract the phase out, well, actually the bottom of the phase out range. Well, that's $2,890,000. With this, we're going to get a negative number, which means we're not limited at all. What we're doing here is we're calculating what our limit is, how much we cannot take in Section 179 expense. All right, so let's change this up a little bit. Let's say that our equipment was $3 million. So in total, we put into service $3,400,000 of personal property during the year. Now, we're going to subtract that. Let's see, 3, 1, so 10 minus 10, 33, 2, 13 is 5. So $510,000. We are $510,000 over that bottom of the phase out range. Step 3, you're going to subtract step 2 from our maximum amount of 179 deduction that we can take, which is the 160. So step 3, we're going to take $1,160,000 minus $510,000. This is going to result in what our deduction is. So what do we have? 50. Sorry, I know this is low. Down here. So 11.6. That's how much our 179 deduction is. 650,000. So, even though we placed into service $3,400,000 of equipment during the year, we can only immediately write off, using the Section 179 deduction, $650,000. The rest of it, we're going to have to use those depreciation methods that we talked about last week. So we'll have to depreciate it over time, and of course, our furniture is going to be over 7 years, our computer over 5, our equipment over 7 years. So we're going to have to use those methods that we used. Okay. Now the downside to this is, so we write off immediately $650,000. If we turn around and get rid of this equipment next year, now we've gotten a deduction of $650,000 that if we had depreciated it over the years, we wouldn't have gotten that deduction, right? Because we didn't hold on to it for the full time. Now what happens is you have to turn around, and it's called a recapture. We have to count as income the amount of depreciation that we took that was too much. Okay, so we are what's the word I'm looking for? Accelerating our depreciation deduction here, right? If you keep that equipment, all of this for the full amount of time, then you don't have any recapture, because over time you would have depreciated it all, right? So taking it, accelerating it wouldn't really make any difference as far as the total deduction that you're going to get. But if you accelerate that deduction and it turns out you don't keep it for the entire period of time that it would be depreciated over, then you've got to go back and recapture the additional amount of depreciation that you took. Does that make sense? It's kind of it's complex. That means you got to keep track of it over the years, right? And you can pick and choose which equipment, which which of these assets you take the Section 179 deduction for. So maybe we take all of the computers and all of the furniture, and then what's left, $250,000 of the equipment is what we claim that 179 deduction for. Okay, so that makes it a little bit, like I said, it helps to, it's designed to encourage companies to purchase equipment, which stimulates the economy, right? Purchase assets, spend that money, and then their reward is that they get to immediately write those amounts off. Okay? Questions about how that Section 179 expense works? Now, you have to use, like I said, it has to be in an active trade or business. Rental property does count, just not the real property part, just not the buildings, because none of the buildings count. It cannot create what's called an NOL, net operating loss. Net operating loss is when you get down to your taxable income and it's a negative number. So this can be further limited. If we had income of $400,000, then we wouldn't get to take $650,000. We could only take $400,000. It cannot bring us down below zero for our net income. You can't acquire it through a related party. So if your dad gives you the equipment, you can't, remember that fair market value for a gift is, and actually we didn't talk about that, but the fair market value of a gift would be whatever it was in the hands of it would be the basis that the donor had, which is different from inheritance. Remember, with inheritance, the basis in that property is what the fair market value is on the date of death. But if somebody gives you property, then you also take on their basis. So for example, piece of equipment, your dad, you inherit a piece of equipment from your dad and he bought it for $100,000 and it's worth $1 million. If you inherited it, your basis, what you get to depreciate is the $1 million. If he gives it to you, what you get to depreciate is the $100,000 that he paid for it. Okay, so there's a big difference there. So if you can't use the Section 179 expense on property that was gifted or inherited from a related party, okay? If you acquired it through trade-in, then it's only the amount that of actual cash that you laid out to purchase that asset. Okay, so if you traded in a truck and the value of the truck is $50,000, but you put $10,000 down, then the most that you can take for a 179 deduction is that $10,000. Okay. I think that's all I wanted to say about Section 179. But this is the big thing, is this calculation. You do have some problems that involve this, and I know your tax return problem has a Section 179 component to it as well. So, but if you can follow these steps, so step 1, total up all the personal property purchases, subtract the bottom of the phase-out range from that. If it's negative, then you're fine. There's no limitation. If your result there is negative, there's no limitation. But if it isn't, then so you subtract step 2 from 1,160,000. That's the amount of deduction that you can take. Okay, so those are your steps there for calculating that. What questions do you have? None? Really? Okay. We'll see about that. All right. So, as I had mentioned, this used to be a really popular deduction, and it probably will be again soon if they don't change the tax law. The reason that fewer businesses were using it is because a more generous deduction was implemented, called the bonus depreciation deduction. Oh, it is 80%. Why does my book say 100%?
My book says 100% too.
I don't think it's 80%. I think that's wrong.
Also, I was doing the smart clip earlier and it accepted 100%.
Yeah, this is why. So one of your homework questions, I was looking through the homework questions, and one of them, the calculation involved 80%. And so I just gave everybody 100% credit on that because I'm like, that's not right. I don't know what they're doing with this calculation. That's interesting. Yeah, my book says 100. Let me double check something. Let's look at the IRS website, shall we? I didn't think that 80% started yet, but I could be wrong. It is 80%. Wow, okay. Do you have the, so your book?
Well, this is the ebook, but I have like a paper copy.
I do too.
And it says 100% there.
It says 100% in here.
Which makes sense, but.
It has been 100%. Yeah, I mean, the ebook should be correct, but, all right. Well,
Confusing.
this is why I said that it was, all right. So I had mentioned, well, I can't undo I guess they were right in the problem. Now I'm gonna I sent them a message and they're probably like, well, you're really stupid. Where'd my marker go? I'll just say, well, I have your printed copy of your book and it says 100%. Okay. The reason for my confusion is for a long time it was 100%. And just starting this year, and well, with the Tax Cuts and Jobs Act of 2017, it was increased to 100%. That was part of the Trump tax cuts. But in order to meet the budget, which they don't meet anyway, but in order to get the costs down of these huge bills, what they'll do is they'll sunset provisions. So yes, we're gonna give you 100% deduction right now. However, in 5 years, that's gonna start to go down. It's not gonna be 100% anymore, it's gonna be 80%. And then it's gonna be 60%. And then it's gonna be 40% until it eventually goes down to nothing. So that's what they're doing right now. So the phase out, obviously, I guess started in 2023. This is really strange that it's, like in the spring I taught this and I swear the book said 100% because I did not, like the ebook said 100%. So anyway, all right. So with 100% or with bonus depreciation, you get to write off 100% of your cost for all assets that have a class life of less than 20 years. So that would automatically exclude any real estate, right? There is no phase out. Like that 179 with the phase out, like you can't put into service more than 2,890,000. I mean, then it starts to phase out. That doesn't happen with the bonus depreciation. Okay, so you can see if you've got a choice between 100% bonus depreciation. I know it's 80%, but if you have a choice between 100% bonus depreciation, where you don't have to do all of that calculation, you can put into service $30 million worth of equipment versus the Section 179. Forget about the Section 179, right? Just take the bonus depreciation. You're gonna have fewer limitations on it. Well, now you will actually probably want to do a calculation on it because now that bonus depreciation is starting to go down. And like I said, in this year, 2024, it's down to 60%. In 2023, it was 80%. So that means that you get, if we had that 3,400,000 of equipment, we get 80% of it. So 2,720,000 is how much you'd get to write off immediately for bonus depreciation. The rest of it, you would depreciate. That other 20%, you would depreciate just like you do over for regular depreciation. So has to be acquired and placed in service prior to December 31st, 2023. Obviously, that's for this tax year. In 2024, it's going to be 60%, and it says it's phased down to 0%, so it won't even be an option after 2027. It won't be available. But for this year, it is. And it's pretty easy to, like I said, doesn't have quite as many restrictions on it as that Section 179 deduction does. Okay, so that's another one of those options. So those are the two main options. You still have to recapture it. If you sell it before you would have fully depreciated it. You're still gonna have to, or you get rid of it, you're still gonna have to recapture that depreciation, right? All right, sorry about the confusion there. Questions about that other than, is it 80 or is it 100? It's 80, but you don't have that homework question anymore, so I guess you don't have to worry about it too much. So here's an example. Equipment, 7-year makers, $570,000 was a purchase price. He can deduct $456,000 by using the 80% bonus depreciation. You can use either the Section 179 or the bonus. You can't use both on the same piece of equipment. Okay, so the remainder he would have to depreciate over the life of the, so it's equipment, it'd be 7 year, would be the remainder of the depreciation. Questions on that? All right. Next up, listed property. Listed property is it's still depreciable assets, but it's property that has some special rules attached to it because it could be used for personal purposes or for business purposes. It used to be that this included automobiles and computers and peripheral equipment. Now it's only automobiles. Okay, so if you have an automobile, there are special rules for depreciating that property. And those special rules apply if it's used less than 50% of the time for business. So all of these assets could be used partially for business and partially for personal, and you can depreciate the business portion of it. For listed property, if the business usage of that property falls below or starts out below 50%, then you don't use regular depreciation like we calculated last week, right? We don't use those tables, it's not a percentage. We're gonna have to use straight line depreciation on it, okay? Straight line depreciation, and it's 5-year property because they're automobiles, so it'd be 5 years straight line. So you don't get the accelerated depreciation, but only if its use is less than 50%. So for example, if we've got a car and it was $15,000 and we use it, say we use it 75% business use, 25% personal. So 12,500 is our business, INESS, and then the other, what do we have, 7, did I get that right? 12,500, yeah, 2,500 is personal. This is the amount that we would then depreciate, okay? This is for listed property. And we would be able to use, because it's more than 75%, we would be able to use accelerated depreciation for that. We'd also be able to use section 179 on that because it's over 50%. If, however, it's not 75, 25, my example here. If it's 40% business, because it's 50% or more business, less than 50%, that's the cutoff. 60% personal, well, now we still get to depreciate it, but what is that? So 4,500 business and 10,500 personal. This is what we're going to depreciate, but we have to depreciate it using straight line. Okay, and we can't use section 179 on it. Okay, you've got to use straight line and it's got to be over 5 years. If we have an asset that, let's say it started out at 75% business usage, but it's fallen to 40% business usage, well, what happens then is we have to switch to using straight line, and then we have to calculate the difference for the depreciation that we already took, the accelerated depreciation we already took. We essentially have to recalculate based on straight line. And then we're gonna recapture any additional depreciation that we took over straight line. So we're gonna have to, we don't go back in time, but now we have income that we're gonna add to make up for that additional depreciation that we took because it was accelerated depreciation. And turns out, because this ended up being a less than 50% asset, turns out we should have been using straight line. So your book talks about, well, there's the list. So passenger automobile, property used as a means of transportation. However, Vehicles that constitute a trade or business such as taxis would not be included in that. So these are vehicles that, like if you've got a minivan or something, but you're using it partially in your business and partially personally. Any type of property, or any property of a type generally used for entertainment, recreation, or amusement, such as a boat. This would include also phonographic, communication, and video recording equipment. So there is a classification. They just don't include the computers and peripherals in it anymore, but that type of equipment, as they mentioned here. Let's see. I'm sorry, more than 50% for business. If it falls to 50% or less, then we have to use the straight line depreciation. It has to be predominantly business use, so that's why it's 50% or more business. So here we've got Jack purchased a large screen for video conferences, $2,500 for use in his home office. Screen is used 70% for business, 30% by his children to play computer games. Screen is predominantly used for business. So he would, it's 5-year maker property. He's going to get a depreciation deduction of $350. That's calculated by taking the full price times the business percentage, business usage, times, then we would use the table to determine what the depreciation deduction is for that first year. If the business use were only 30%, then he would have to use straight line depreciation. So it would his deduction would end up being $75 instead of $350. Full amount of the asset price times business use percentage of 30% times 10%. So that's for the first year. Why is it 10%? Let's go to that. Oh, half year convention, that's why. Because he only had it, for the first year it would be half year. Oh, come on. No. There we go. That would be for the first year. For the next year it would be 20% because it's okay. This is about the recapture that I was just talking about. Here is a calculation for the recapture. So assuming the same facts, but the business use was 70% in year 1, but 30% in year 2, now we're gonna have to go and recapture the additional amount of depreciation that we took. So you calculate what your maker's depreciation is, and then what your straight line depreciation would be, and then you've got to recapture then $175 because that's half of the 350. So in that first year, we took 350, but if it was straight line, it should have been $175. So the difference between those two is the amount that we're gonna have to now include that in income. But this year we do get a depreciation deduction of $150 after doing the calculation of what it would be for straight line depreciation, okay? Questions about that? That's listed property, okay? It's just some special rules because it is partially business and partially personal. Okay. All right, listed property. I'm sorry, luxury automobile limitations. This is kind of a misnomer because I wouldn't exactly call their dollar limits luxury. Essentially, you are, if it's considered a luxury automobile, that is essentially any personal's not the word I want to use. Passenger, that's the word I want to use. Any passenger vehicle that is under 6,000 pounds. So that essentially is most passenger vehicles, but they figure if it's 6,000 pounds, it's probably being used for it's not so much being used as a passenger vehicle. It couldn't be used really as much for a passenger vehicle. There are some trucks that obviously, some huge trucks out there that can be used, but 6,000 pounds is the magical number. So if it's a passenger vehicle, so we're not talking about other types of vehicles like buses or, I don't know, tow trucks, things like that. Those aren't passenger vehicles. But if it's a passenger vehicle and it's under 6,000 pounds, again, we have some special rules with regard to depreciation for those items. You cannot take, we are limited to how much depreciation we can take each year on those vehicles. The first year, if we take bonus depreciation or section 179 depreciation on a luxury vehicle, the most depreciation we can take is $20,200. So that's why I say it's the word luxury is kind of a misnomer, because for most folks, $20,000 car is not a luxury vehicle, at least anymore. I suppose a while ago it may have been, but nowadays it's certainly not. But the most that you can take for a depreciation deduction is $20,200 if you take section 179 or bonus depreciation on it. So if you have a passenger vehicle and you paid purchase price $60,000, in year one you take bonus depreciation on it, but you can't take 80% of the bonus depreciation on it. You can the most you can take is $20,200. The remainder of it, you're going to have to depreciate it then. You're going to be limited to these amounts of depreciation in succeeding years. Essentially to prevent people from buying a Maserati and writing it off 100%, right? So it's to limit those deductions for automobiles. If for some reason you don't take section 179 or bonus depreciation, then your limit in the first year, the limit of total depreciation is, so this is with bonus or 179, without bonus 179, the limit is $12,200. And this is for 2023. Okay, so that would be, if you're just using regular depreciation, the most you can depreciate then would be, in the first year, is $12,200 of depreciation. And then the rest of it, you just depreciate normally over these are still the limits. So if you didn't, your year two would actually be higher in this case, what you can take. And that's what that's saying there. So for example, with that Allison, she bought a Toyota Camry for $25,000. It was used 100% for business. So if it's, excuse me, if it's not used 100% for business, these limits are going to be based on the proportion of business use. So your limit is going to be lower as well. And there's an example here I'll show you. So here, $25,000 Toyota Camry, hardly a luxury vehicle. 100% bonus depreciation produces a deduction of $25,000. However, so she's going to take the bonus depreciation. Actually, it wouldn't be $25,000. See here, they've even got the 100% here. They didn't change it. Somebody didn't proofread this book very well. So let's just say, what's 80% then of 25,000? 8 times 25, $20,000. See, it doesn't work if you're using the 80%. All right, we'll assume for a moment it's 100% bonus depreciation. So if it was 100% bonus depreciation, she'd get to take the full amount, right? She doesn't because it's 80%, but you know. But the maximum that she can actually take is that $20,200 because it's a luxury vehicle. because it meets that definition of a luxury vehicle. Excuse me. So these are just some special rules because of the classification of the asset, what type of asset it is. Now, here's Jackson. He purchased a vehicle for $20,000. He used it 75% for business. Well, because it's 75% for business, we have to take 75% of that maximum amount that he's allowed. And that's gonna be his depreciation deduction for that vehicle, $15,150. Again, just because this only pertains to vehicles, passenger vehicles under 6,000 pounds. Most of these complex rules are designed so that to try and prevent abuse of the deductions. That's why they get complicated, right? If we didn't have, if everybody was upfront and honest and it operated in good faith, we wouldn't have to have such complex rules. But that is not the case. People always try to find a way to work both within the rules and outside of the rules. Okay, so those vehicles that are over 6,000 pounds have some special rules as well. If it's over 6,000 pounds and it's like a truck or that dump truck that I was talking about, there's no limit. You can use the bonus depreciation, you can use the section 179, all of that. However, if it's an SUV, there is an exception to it. I think it's for SUVs. Let's see. Current bonus depreciation. So it's 28,900. So a lot of those big SUVs, like people were buying, and this is about the time that I started practicing actually. We had all sorts of clients who went out and bought Hummers. Huge vehicles to get around that $6,000 pound, or that 6,000 pound limitation. So even though it was still a personal vehicle essentially, I mean it was business and personal, they, because it was over 6,000 pounds, they would be able to write off all of it. Well, now, if it's over, the limit is 28,900. Okay, so that's kind of the difference between if it's more than 6,000 pounds or less. So here we got Javier, purchased a new GMC Yukon for $46,000, May 3rd, 2023. I doubt you could get a new Yukon for $46,000 in 2023, but hey. 100% for business. He could deduct a maximum of $28,900 in 179 expense, but then he could also take the additional maker's depreciation of $3,420. So he's depreciating the remainder over the 5 year using the half year convention. But he can get around all that by just taking bonus depreciation. And again, they've got 100% here. All right. So again, all of those things, I mean, the section 179 expense, just to kind of recap, section 179 expense, because that bonus depreciation percentage is coming down, that's going to be used more frequently again. It is, however, limited based on the total amount of personal property that you place in service during the year. And it's not for any real property. None of this is for any real property. Real property, you're just using that 27.5 year, 39 year straight line method. There are no special rules really for that. But the 179 expense deduction has that threshold though, that limit of how much you can place into property, into service. Bonus depreciation does not have that limit. You can place as much as you want into service, but it is an 80% limitation, so it's just based on 80%. And then listed property has to do, are those special rules that pertain to mostly automobiles, but other types of equipment that could be used for personal purposes as well as for business purposes. And for listed property, remember it matters whether, the cutoff is that 50% business usage. So if you use it predominantly for business, you don't have to use that straight line depreciation. But if it does fall below 50%, then you have to use straight line depreciation over 5 years, and you've got to recapture any additional depreciation that you had taken. And then the luxury vehicle restrictions, that is to limit the amount of depreciation you can take for each year to prevent individuals from buying really expensive cars and writing them off in full, and then using them really for more for personal purposes. But so those are what those rules all entail. Questions? I know that's confusing. So I know the look on all of your faces, I understand, it's familiar, I get it. It's these are confusing rules, but essentially they're just like exceptions to that whole depreciation thing that we were talking about. There are some special, if you lease a vehicle, there is a special chart that the IRS puts together on how much you can deduct for your lease payments. So, so the IRS limited the lease deduction for vehicles, requiring taxpayers to include a certain amount in income to offset the lease deduction. This is called the lease inclusion amount. So it's based on the vehicle's fair market value and the year in which the lease began. You deduct the full lease payment, but then you add back this income inclusion, which nets out that deduction. So it's in that table is in one of the revenue procedures, and it's listed every year. So essentially, you deduct what your lease payment is, but based upon the year in which you began the lease and based on the vehicle's fair market value, which the IRS gives you, there's that in that table, you add an amount back. So you're reducing that deduction by a certain amount. You have to keep records for all of this, of course. You got to keep adequate records and make sure that they are, you don't include any of it with the tax return when you send it in, but if you ever get audited again, you do have to have all of that, those records. That's depreciation. Questions?